Yeah. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be presenting the Asian session live market analysis and the forecast for this week now, that is 18th to 22nd of April. And today we are on 18th of April between 5 and 5:30 GMT. I am going to explain to you the expected market moves from Monday to Friday, the session-wise forecast, and also the range in which the currencies are expected to swing, the four majors and two commodity pairs. Besides, we'll do the market reading and also briefly touch upon the trading strategies. And those who want to contact me can note down the email ID, dr@i-knowindices.com, and my Skype chat ID is iknowindices@hotmail.com, so that you can contact me and ask me for any help. Then my website is www.i-knowindices.com. It is there since 1999. So we will go to the top of the forecast for this week. So it is a derived forecast, and I am using a sequential statistical analysis by which I am able to give the forecast for the market for the weeks and months, and that is inclusive of timings. So my forecast is also referred to the timings of the market. That means, so what is going to happen during the Japanese, European, and US session, etc. So it is not the question of, or it is not a mere study of identifying the supports and the resistance or what could happen during the data release, etc. Besides, I fine-tune the forecast using the market reading technique, identifying the intentions of the players. So the intentions of the players can be easily followed when we try to track their type of moves they are doing it in the market. So that we will be doing it in the market reading. Besides, in the event if we go wrong, if the market goes against our expectations, what are the strategies or what are the steps we need to take so that at any given time we don't develop the market surprise. So once we develop the market surprise, and if the market goes against, we become panic. If the market goes in our favor, we become stunned, and also we become greedy. So both the panic and the greed conditions invariably make us to do the distress trades, because it is a way of the fear creation, and that fear is giving us the wrong impression about the market. So if we use the trading strategy, we can get rid of the fear most of the time. So coming to the forecast part of it. So this is the forecast for the third week of April, 18th to 22nd of April, and each session wise expected market moves are given here. Japanese session 0030 to 7 GMT, then European session 7:30 to 13 GMT, then US session 13:30 to 20:30 GMT. In between the sessions, you come across here about 30 minutes, 7 to 7:30 GMT is a gap time. Then 13 to 13:30 GMT is a gap time. Then 20:30 to 0030 GMT of the next day is another gap time between the sessions. During gap time, the players try to make quick moves and also false moves in order to hit the stops of the traders. So keep in mind, it is a man-made market. In the man-made market, we should not expect always an extraneous trigger is necessary for the market to gain the momentum. The players at any given point can give the trigger to the market either by using the excuse the data is positive to US dollar or data is negative to US dollar, or they can simply create a rumor and then try to make it as US dollar positive or US dollar negative moves. Besides, they can also give the interpretations with regard to the technicals namely the oversold, overbought condition. The market was rejected near that of the resistance and it was well supported near that of the support, etc. So these are all various type of terminologies the analysts conventionally use, and they try to bring in their possible forecast. But ultimately what happens when you follow such forecast and try to take the positions, the players extend the moves little more and try to hit the stops and then make the move in our favor. So we need to understand when they are going to make the stop ends on the upside or on the downside. So basically, based on the time frame, we need to know whether they are going to do in this particular session, yeah, dip and the firm up move, a small downward stop and followed by that of the rise. Then again a small downward move and then rise. Then a small downward move and the small firm up move. So I have given the explanations when I use these qualitative expressions like the firm up and the rise, quick rise, etc. in terms of the pips, about 15-25 pips or 30-35 pips and 65 pips rise, and also quick rise about 95 to 100 pips. Similarly, a dip, drop, and also extended downward move. So they make such moves on the upside or the downside depending upon the trader's pending positions. So the qualitative expression is a general expression pertaining to the numerator currencies. Besides, the denominator currencies may also show the contrarian move that we can find out with the help of the live market code page. So suppose the dip and firm up is pertaining to that of Euro and GBP and also Australian dollar, we come across a small dip and then firm up. Now in the net change is in positive in the case of Euro, whereas in the case of GBP the net change is still negative 37 pips. But in the case of Australian dollar it's about minus 61 pips. That means what? From that of Friday close, Euro has gained about 4 pips, GBP has lost about 37 pips, and Australian dollar has lost about 51 pips. That is what the net change referred to that of the previous day close. So here you come across variations with regard to the pips. So you need to understand why they are making such moves. And also you can easily identify, in the case of yen, they are showing 81 pips negative net change, which is showing the USD weakening move because yen is becoming stronger. In the case of GBP, it is 37 pips negative net change and also Australian dollar 60 pips negative net change. So when denominator currency USD yen is showing negative net change, that is a USD weakening move, we expect GBP to rise and show the same USD weakening trend. Whereas here it shows USD gaining trend. This is referred as a contrarian move. So they make such contrarian moves. So we need to understand why they are making such contrarian moves. They are mainly done in order to handle the respective crosses. If you refer to the GBP yen cross, then the negative net change will be bigger because both are in negative condition. GBP yen is about 1.154 pips negative net change. So this way we can easily identify that they make only 70 to 80 pips, 79, 80 pips negative net change in the case of yen and 30 pips, 30, 36 pips in the case of GBP. So cumulatively it is about 100 pips, but the pip range is higher in the case of yen. So as a result, you come across that about 150 pips negative net change in the case of GBP yen. So this way and also similarly in the case of yen is negative net change and Australian dollar is also negative net change. So Australian dollar showing negative net change is the USD gaining move. Yen showing negative net change is the USD weakening move. It's a contrarian move by which they show the Australian dollar yen about 115 pips negative net change. So understand that the players make the moves in the case of the majors in order to bring in the variations in the net change, also the swings in the case of the crosses. So that we have to keep it in mind. Always you look into that of the live market code page in order to understand how they are going to do it. And also you come across the GMT time frame, because if you follow the GMT time frame, then you will be able to track the market 24 hours irrespective of our local times. So then you will be able to understand, okay, Japanese session is up to 7 GMT, up to 13 GMT is the European session, 2030 is the US session. Then the US session gets over. Then you can continue using the GMT time frame irrespective of the local time, the country you belong to, wherever you are staying. Irrespective of that, you follow that GMT time. Then it is easy for us to understand how they are making such moves in the market. But conventionally, the analysts use the different terminologies, or they simply call it as a European session, the Japanese session, Asian session, the European session, then UK session, New York session, Pacific sessions. Various timings and various names are being attributed, mainly in order to confuse the traders to follow different time frames, so that the traders continue to find the market as a surprise. So when the traders continue to find the market as a surprise, then the fear grips in. Then immediately they either trade with a stop, because the greed to earn money is there, or the necessity is there to earn quick money. At the same time, the market fear also is there. So what happens? The traders try to use the stops. Then the players find it very easy to hit the stops and make the moves. As a result, the players are able to continuously earn money, and the traders find it is extremely difficult to earn money from the market. So this is what we need to understand in the man-made market. So manipulation plays a vital role. For that, we need to read their intentions following their language. That is what I am trying to give it here. So dip and firm up during the Japanese session, swing and rise during European, swing and firm up. Swing means they will be making a higher level swing and then come down a little bit and continue to firm up slowly. Then dip and rise mean initially there will be a downward stop, and then they will start gaining and make an upward stop and come down a little bit, and then induce the traders to sell, and then continue to rise, induce the traders to do the short covering. So either way they will try to make the moves in order to induce the traders to make or reach the distress condition, whether the market is in the upside move or on the downside move. The traders have to get confused, and then many people will say that market is going to be range bound. Immediately the traders will also think that market is going to be range bound, so any firm up will try to sell. That is what they try to take a decision and then take the sell position, but weakened they gain more and more, induce them to do the short covering. The next week will be the last week of April, and 25th to 29th. So the last week of the month and the first week of the new month, they will be making the monthly trend reversal moves. So during the monthly trend reversal, the market will be highly volatile in order to handle the derivative markets, the futures and the options, and also the forward covers, etc. So keep in mind, the players are here to trap, and we have to be smart enough to take advantage of such moves in the market. Now, coming to that of the range in which the currencies are expected to swing in this week, Euro could make the swing, the low as 1.1275 to 1. The high could be 1.1675, and in the case of GBP 41.75 to 46.75, and in the case of yen 108 to 112.25, and below 108 is a great buy opportunity, and then 96.50 to 99.75 could be the range in the case of CHF. Then Canadian dollar, they are making the initial upward move. After making a quick downward move, you can see The net change has already become 134 in the case of Canadian dollar. That is how they just start the week and then make a quick upward rise, induce all the traders to feel that USD CAD has become bearish, and then the traders will try to take a buy. Later on by weekend, they will start making the slide, induce them to do the long liquidation. In the case of Australian dollar, again in a hurry, they make that drop in order to consistently gain the level from 76.50 area to that of 79.25 area. These are all the ranges in which the currencies are expected to swing. They are all mathematically derived levels, and closer to those levels, you will be able to find the market is bringing in the turnaround. Then coming to that other market reading. So we note down the initial lows and the highs using the live market code page. The low and the high set around 3:30 GMT. Then we try to track the market following it, whether the high has been breached and the market has gone above, or low has been breached and they continue to go down, so that you'll be able to understand what the move they intend to make. So you know the type of moves that they make. 30 minutes, less than 30 minutes move, namely the stop ends either on the downside or on the upside. Downside below that of the initial low, they make for about 30 minutes, they move downward and then start gaining above that, stay there for 30 minutes and continue to gain the level. So this way, they make a brief downward stop and then start rising, it breach the high and go above, stay there for more than 30 minutes and continue to gain the level. This is one way of inducing the traders to short and do the short covering during the day. The other type of move is they just, if the predominant of the traders are holding long positions with a bullish feel, they go below that of the low and stay there for 2 hours. Then the traders taking the long position at a higher level or a breakout trade feel that they have taken the wrong position. You will stop out and turn seller, or you will take sell position. Once they stay below that of the initial low for more than 30 minutes, up to 2 hours, but they fail to recognize that they stop cutting the new low. The new low might be hardly about 5-10 tips below that of the low, but they think that the market might collapse. Then immediately they take the sell position, but the players after 2 hours gain the level, go above that of the initial low, stay there for about 10 to 30 minutes and start gaining the level, go breach the high, stay above there for 30 minutes and continue to gain. So this way, they induce the long liquidation and then induce short covering by rising the market. That way, they trap either way. The traders holding long positions are also trapped, along with it of the traders holding short positions. Then you come across the intentional move. That they do it as they breach the low, stay there for more than 30 minutes, continue to breach the new low every 30 minutes, and it's a slow move. Then it is an intentional move on the downside or an intentional move on the upside. So the extended move is always a quick move and very, very fast and reverse in 2 hours. Whereas the intentional move is the one they continue to breach the new lows every 30 minutes and over the sessions. And the third session, they just breach the new low and quickly reverse the market. So they don't do hat trick. They don't continuously drop the market for more than 2 sessions or more than 2 days. So that you need to keep it in mind. So these are all the type of moves they try to do it, and that if you recognize, you can trade along with that. For that, we note down the initial lows and the highs and see how the market is behaving. And if the spread between the high and the low is less than 40 pips, then don't commit positions because they may not give sufficient profit or 15-20 pips profit. So that if you simply take the position, market will be holding and it may test your patience. Once the spread becomes more than 40 pips, you try to take a position closer to that of the low, a buy position, closer to that of the high. If it is not breached, if the market is there for 30 minutes near the high but not breached it, you take a sell, you'll be able to make a definite profit. and you can keep 30 pips hedge order below that. And once the position makes profit, keep stop at entry and remove the hedge order. Now coming to that of the initial lows and the highs, in the case of euro, you can see that 1.1277, 1.1307, both the lows and the highs are not breached. In the case of JBP also 4163, 4200, they are not breached, and 107.85 in the case of USD and 108.47, they are not breached. 92.52 and 92.78 are not breached in the case of USD CHF. In the case of Canadian dollar, 1.2931 is the low, 1.2986 is the high. They are also not breached, even though the spread is less, but from that Friday close, quickly they gained the levels. That is why the net change is very high. And in the case of Australian dollar, 76.31 is the low, 76.78 is the high. They are not breached the low or the high. So in none of the currencies they breached the low or the high, indicating that the market volume is less. People are uncertain whether the market is going to be bullish or bearish, and so they are waiting for the traders to commit positions, and later on they will try to make the moves. So, but as a basic trading strategy, we will try to keep a buy limit order 1.1277 and 30 pips above the exit or the take profit order, and 30 pips below that of the entry level, the sell stop, that is the hedge order. Similarly, in the case of GBP, 1.4163, a buy limit order, and 1.4193, the exit or the take profit. 1.4133 is the hedge order to limit the risk. Once the position is or the limit order is filled and the market moves about 15-20 pips above, then we try to keep stop at entry and remove the hedge order. Then afterwards, once the market starts gaining, we can move the exit order higher, and use the stop at entry as the trailing stop. So you make it as a manual trailing stop, because many of the platform you find the platform providers capture the stop and fill it. So you try to manually move the stop in the entry level and above, and you can just take away 30 pips every time the exit or the take profit order. As a result, you will find when the market goes up, either you should fill your trailing stop to give a minimum profit, or fill your exit order to give the maximum profit. That way you can maximize the profit. So it is not the trading strategy limited to that of limiting the risk, and also you should use the trading strategy to maximize the profit. That also you keep it in mind, so that once you eliminate the risk, you will be in a position to effectively maximize the profit in single trades. So these are all the market timings now, and the daylight saving system is on in Europe and US. As a result, you come across the Japanese session gets over by 7, and 7 to 7:30 is the gap time. Then 7:30 to 8:13 GMT is the European session. Then 13 to 13:30 is the gap time. Then 13:30 to 20:30 is the US session. 20:30 to 0030 is the gap time before the start of the next day. Each session is divided into early, mid, and the late sessions. And first 1.5 hours and the last 1.5 hours of the early and the late sessions. During that time, they handle the majors, bring in the upward or the downward stop in the case of majors. And during that of the mid session, they make only the range bound swings in the majors, but contrarian moves in order to handle the crosses. We just watch the timing and also see how they are making the moves with the help of the live market quote page in all majors in the commodity pair, and also the crosses. Then you will be able to understand how vital the market timings are. Systematically they do it, and if you know the timings well and by heart, then you can automatically fine-tune your trading decisions. Then you will find that your waiting period After taking the position, you will be very, very short and you will become an opportunity trader. That means you just wait for a great opportunity to happen and then quickly grab and book profit and spend the rest of the time for your other lively activities. So you will not be glued to that of the market. You will not be compromising your life. You will not get angry with everybody who disturbs you or ask your wife to keep shut when she is asking you to do something. Say that I am very busy with the market. Okay. So if there are any questions, you can ask me the questions. I'll be willing to answer to the questions. So my next Asian session live market analysis will be on 25th of April, next Monday. That will be the last week of the month of April. And during that time, the market is going to be very volatile. And I'll explain to you what are the expected market moves. Keep in mind that the players are here to trap. And so we have to outsmart them, understanding the tricks. And it's nothing more than tricks, because they cannot put their hand through the computer screen and catch your hand and say that sell after the drop or buy after the rise. They can only induce your fear and automatically you do that. So see that the market does not induce your fear. For that, you need to have a trading strategy to limit the risk, and then automatically you are able to maximize the profit. Thank you, KP. Is there any question? So that I'll be willing to answer those questions. I'll display the forecast for this week. So those of you join late probably can make a note of it. Will the USD turns around in this week, Jason? Yes. It's a great opportunity to buy USD around 108 and hold it, and you will come across a substantial gain in the case of yen and yen crosses. They are simply consolidated. Last week also they handled the crosses to a greater extent in order to accumulate positions, and they are expected to make very big upward move in the case of Euro and GBP, and moderate upward move in the case of USDN and USD And you can see that USD they came down to 0.95, from there they gained it. In the case of USDN, they came down to 107 and then started gaining it up to 109 last week Friday. And this starting of the week, again big beginning false move, they made the downward move when Euro and GBP also, when they are making the downward move from the Friday close level, and later on they are expected to gain the levels during the week. From European session onwards, you will come across the gains. Always look into that of the live market code page. You will be able to understand when they are making the contrarian moves. Don't take positions in majors, because you may not be able to make good profit. You focus on the crosses at that time. When they are making USD gaining or the USD weakening move overall, then you try to take positions in the majors. You'll be able to quickly book profit. So follow the market timings and identify what pairs they are handling at a given time. Then take positions. If you look into that of the individual charts of the various currencies, you may not be able to really correlate. And see, many people just look into that of the chart pattern and say that, okay, similar to that of yen, they are making another metal, or similar to that of euro, they are making a stock move. And these are all nothing but the coincidences. And the players here in the stock market are different from that of the Forex market. They make different type of moves depending upon the volume and depending upon the traders' pending positions. So don't try to correlate. That is why when you try to correlate, when you see that euro is gained, and so USDN is making a dip, then immediately if we think that USDN is going to make further drop, they may not make a big drop because they formed the new low and 107.85 for the day, and still they are not cut that. So at the maximum, they may make a small downward stopping before making an upward rise, or a false move up to the low and then rise. That sort of moves they are expected to make it. So if you want to take position, buy position in the case of USDN, wait for the late session and see the move they are doing it, and then take position so that you will be able to really keep stop at entry. Always keep in mind, after taking the position, the market should give you a great opportunity of keeping stop at entry. That means after taking the position within 30 minutes, you should make profit. So choose the timing, then you will be able to really do that. So no more questions here. So I take this opportunity to thank FX Trade for the facilities provided. So I take this opportunity to thank FX Trade for the facilities provided to present the webinar, and you people for your patience listening and also understanding how the players are trying to trap us and how we have to be smart enough to get rid of such constraints. So I'll come back on next Monday and give you the forecast for the next week, and wish you all happy trading and wish you all prosperity in life. Thank you.